Hey, it's Vince Bart with the Victoria Property Specialist Group at Remax Camosun. I'm with Duncan Gardner of Great Pacific Mortgage. Hey, Duncan, how's it going?
Doing good, Vince. How you doing?
Pretty good. So this is the next part in our series of videos for those that are just joining us for the first time. This is a series of videos talking about mortgages and all of the financing side of the real estate world. So for today's video, we wanted to talk about the different types of mortgages. So Duncan, can you jump us through those different types of mortgages?
Yeah, absolutely. Essentially, there are three types of mortgages that a borrower can apply for. There are insured, also known as high ratio mortgages. There are insurable mortgages, and then there are uninsured mortgages. The insured mortgage, also known as the high ratio, is the one that most people end up going for, especially first-time home buyers, because it requires the littlest down payment. So with an insured mortgage, you can put a minimum of 5% down and anywhere up to 19.99%. With an insured mortgage, there are a few guidelines that must be followed, and these are mandated by the government. And part of that has to do with the mortgage default insurance, which we'll talk about a little bit later. But essentially, an insured mortgage has to be amortized over 25 years or less. So that's spreading out the loan within 25 years. It cannot exceed $1 million in purchase price. It actually can't even be $1 million. It has to be $999,000.99. And finally, as we talked about, it's less than 20% down payment. With an insured mortgage, it will have a mortgage default insurance, which is a premium added to the mortgage. This is a premium that is paid for by the borrower, but to the benefit of the lender.
Okay. So when people say things like CMHC or Genworth, that's that type of insurance that you're talking about.
Yeah, absolutely.
Okay. And so you mentioned the insurable mortgage.
Mm-hmm.
If it's insurable, why not just get it insured, and what's the difference?
Yeah, it's a great question. Essentially, they are almost the exact same thing with two minor details that are different. One, this is a situation where the borrower has at least 20% down. So this is an example of someone that's, say, selling their home and buying a new one, and they have enough equity where they're going to be able to put a substantial down payment down. These would be quote unquote insurable if they're going to go and purchase a new house and they've got 20% down payment. The reason it's insurable is because everything else remains the same. It still has to be under $1 million for a purchase price. It still has to be amortized over a maximum of 25 years. Now and these are also still insured, but the insurance, the mortgage default insurance, is actually bulk insured by the lender. So rather than the borrower paying for this insurance, the lender actually pays for it. And while it can get a little complicated as far as how they insure it, essentially it means that the borrower isn't paying that premium and it's not added to the mortgage.
And so then that leads us to the last type, which is the uninsured or uninsured. It can be insurable and be uninsured, but what's an uninsurable mortgage, and how does that impact you as a borrower? Because if you're borrowing money from a lender and your mortgage is insurable, but you're choosing not to have insurance, what's the difference between that and uninsurable?
I wouldn't even think of it as choosing not to have insurance, because I know insurable sounds scary. And I think people need to remember the insurance that we're talking about, the mortgage default insurance, is not insurance that's there to protect you. It's there to protect the lender. So if someone defaults on their mortgage, that the lender has insurance to back it up and sort of protect their investment. When it's uninsured, that means that there is no mortgage default insurance. So there are certain types of mortgages that cannot be insured. One is a refinance. So if you're trying to pull some equity out of your home, or if you're trying to extend your amortization and lower your monthly payments, that cannot be insured. So that is an uninsurable mortgage. Another example would be a rental property. A lot of people think that, they're just going to go buy a rental property and put 5% down. You can't do that. Rental properties, minimum 20% down, sometimes 25% down, and they can't be insured. Now, one of the nice benefits of an uninsured mortgage is that you can actually extend the amortization up to 30 years. So you've got that extra 5-year cushion where you can spread your payments out and potentially lower them. Comes at a catch. Uninsured mortgages are typically a higher interest rate than insured mortgages. Makes sense. The lender's taking on more risk because they have that insurance to protect them. So they charge that risk to the borrower.
Gotcha. Okay, so with the insured mortgage, you're paying the insurance for the bank to be covered. With the insurable mortgage, the bank is paying the insurance potentially for the bank to be covered. And with an uninsurable mortgage, you have way more flexibility, but you need to have a much larger down payment, and you're likely going to have a higher interest rate. Did I get that
Absolutely.
right?
That's 100% correct. And you
Perfect.
touched on a really good point about being way more flexible. Uninsured mortgages do not have to follow the mortgage insurance guidelines. So that sort of maximum GDS, TDS calculation, which we're going to talk about in another video, is basically thrown out the window, because then you're jumping into different alternate lenders where they have flexibility with those ratios. So you're right, it comes at a benefit. If you've got lots of money to put down in your house, there's some flexibility as far as how you can debt service it.
Okay, great. Thanks so much.
Yeah, you're welcome.